The current live stock price for RegenCell Bioscience Holdings Limited, ticker RGC, is $14.54, reflecting a gain of 71 cents or 5.13% in today's intraday trading session, a noticeable upswing that will undoubtedly catch the eye of traders focused on high volatility names. Now, while the immediate market narrative is focused on this strong intraday jump and the company's recent dramatic volatility, it had a 52-week range swinging wildly from a mere 0.09 cents to over $83.60. The true intrigue here is not the raw price movement itself, but the underlying institutional activity. Forget the retail trading chatter for a moment. What's genuinely unexpected is that despite the company's microcap status, limited revenue, and the highly speculative nature of its traditional Chinese medicine focus, institutional ownership is not only present, but has shown signs of accumulation, specifically a huge percentage change in shares held by institutions in the most recent reported quarter. Firms like Geo Capital Management, SquarePoint Ops, and others are listed among the owners. This small but growing institutional footprint in such a volatile, thinly traded name forces us to look past the usual pump and dump warnings and ask, are these sophisticated players anticipating a legitimate catalyst, or is this simply quantitative funds playing a complex volatility and momentum strategy, where the sheer size of the swings itself becomes the alpha opportunity? The general market expectation is straightforward. RGC is a classic speculative biotech play, characterized by extremely high beta, a staggering 2.00 in the 5-year measurement, and a complete disconnect between its massive valuation swings and its current fundamental reality of being an early-stage company with negative operating income and minimal revenue. The belief is that this stock moves purely on sentiment, social media buzz, and short squeeze potential, especially with the high annualized borrowing fee that has been reported, which puts immense pressure on short sellers. The short percentage of the float is significant, sitting around 7.37%, a figure high enough to fuel dramatic volatility upon any positive news. However, the contrarian take demands a deeper look at the context of the recent regulatory and legal disclosures. Not only did the company recently file its annual report, but it also had to disclose a Department of Justice probe into the trading of its shares, which, rather than crushing the stock permanently, only resulted in a temporary drop before the volatile nature reasserted itself. This is the central tension. The expectation is volatility driven by retail enthusiasm, but the reality is that the stock has shrugged off serious legal and financial going concern warnings, suggesting a core group of conviction holders or strategic institutional players are either immune to or actively exploiting this chaos. For those utilizing platforms like the Interactive Brokers trading platform, the sheer depth of the order book and the speed of execution become critical tools for navigating this kind of unpredictable swing trading, which is a world away from the longer-term investment strategies you might pursue with a Fidelity brokerage account or the automated low-risk approach of a Schwab Intelligent Portfolio. Drilling down into the recent stock movement, the current 5.13% daily move, while substantial, is relatively subdued compared to the multi-100% swings RGC has experienced in the past. Today's volume is noteworthy, with the trading volume being significantly higher than the average, indicating a fresh wave of transaction activity fueling this afternoon rally. This elevated volume, alongside the recent massive run-up, a staggering 7,704.06% increase over the last 52 weeks, shows a powerful sustained narrative driving price, even if that narrative is speculative. The macro environment, especially surrounding U.S.-listed Chinese small-cap stocks, has been highly scrutinized, adding another layer of geopolitical risk to RGC. The fact that RGC is developing traditional Chinese medicine, or TCM, formulae for neurocognitive disorders like ADHD and ASD, adds a layer of novelty and potential disruption to the traditional biotech and pharmaceutical industries. But it also introduces significant regulatory hurdles, as TCM is not recognized under the same frameworks as Western medicine. This constant tension between a high-risk, high-reward narrative and the low to no revenue fundamental picture is what defines the RGC stock experience. We need to talk about the business model clearly and directly, because this is where the market narrative and the company's actual operations diverge completely. RegenCell Bioscience Holdings Limited is an early-stage bioscience company headquartered in Hong Kong. Its entire focus is on the research, development, and commercialization of TCM formulae, specifically targeting neurocognitive disorders like ADHD and ASD. Their pipeline consists of 3 standardized liquid-based TCM formula candidates for mild, moderate, and severe conditions. The formula are derived from a base formula developed by their TCM practitioner, Mr. Sik Ki Ao, who is also the CEO's father. The clinical support for this, as stated in their own filings, is based on a Sik Ki Ao TCM brain theory and satisfactory clinical results, but not on controlled clinical data or trials recognized by most Western regulatory bodies. Let that sink in. Their current valuation is built not on revenue, which is negligible, or approved commercialized products, but on the perceived promise of a non-traditional medical approach for conditions with immense global market need. They have minimal employees, less than $5 million in cash, and a negative net income. This fundamental weakness is precisely why the stock is so vulnerable to volatility. Without a solid operational base, every piece of news, every rumor, and every high-volume trading day can send the stock flying or collapsing. This is a very different kind of speculation than an established growth stock like Apple stock or a market-moving technology leader like Nvidia stock. It's a niche, high-stakes bet on a long-shot outcome. The company's past performance is a study in extreme price action. The stock split and subsequent dramatic run-ups, followed by equally sharp corrections, illustrate a pattern of extreme speculative trading, often halting multiple times per session due to volatility. This kind of market behavior underscores the need for sound investment help, and not just self-investing based on social media trends. Whether you are using the Robinhood app for quick trades or a comprehensive system like the Fidelity trading platform, the risk profile here is off the charts. The price has been supported not by quarterly earnings beats, which are non-existent, but by the successful narrative around their first research study using personalized TCM formula, and the hope for subsequent market launches in Hong Kong and potentially beyond, as well as a joint venture for COVID-19-related treatments in ASEAN countries and others. The company's financial health, measured by a negative return on equity of -54.81% and negative return on invested capital of -34.37%, tells a story of a company burning capital, which is normal for an early-stage biotech, but not sustainable for a stock with a multi-billion-dollar market capitalization based on its recent high watermarks. Looking ahead, the future outlook for RGC is entirely dependent on regulatory and clinical progress, not market adoption of an existing product. The primary catalysts will be the commencement and results of their second research study on the 3 standardized TCM formula candidates. Should they achieve a statistically significant positive outcome that satisfies regulatory bodies in a viable market, starting with Hong Kong, then potentially expanding, the stock could see another parabolic rise. The opportunity lies in the sheer size of the ADHD and ASD markets, which are massive and are still searching for diverse and effective treatment options. If RGC can demonstrate efficacy in a formal, recognized capacity, the upside is substantial. However, the risks are equally great. The Department of Justice probe adds a layer of uncertainty that could result in substantial financial penalties or management distraction. Furthermore, a negative or inconclusive result from the next research study would fundamentally shatter the current fragile investment narrative, likely leading to a rapid and severe price correction that could bring the stock back towards its 52-week low. The highly concentrated insider ownership, while showing conviction from management, also means that any large-scale selling by these few shareholders could crash the stock instantaneously, a key consideration for anyone doing online investing in such low-float names. Think about your own online investment philosophy. Are you a trader looking to scalp the daily swings, or are you trying to build a long-term portfolio? This is a question the stock forces you to answer with every price tick. To engage with this idea, comment below how many shares of RGC you currently hold, if any, and what your personal price target is for the next 6 months. Do you trust the clinical investment narrative, or are you purely playing the technical momentum? In summary, the narrative around REGEN-Cell Bioscience is one of extreme, almost fantastical speculation. The expectation is that this stock is just another meme-like retail-driven pump that will eventually crash back to earth due to its weak fundamentals, lack of revenue, and serious legal disclosures. The reality, however, is more nuanced. The stock's volume and intraday strength, like the 5.13% gain to $14.54 we see today, persist, supported by surprising, albeit small,